Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about mortgage rates and the economy. So some of the Fed governors came out and they had some comments to say about where they think interest rates are going to go. And then we'll talk about how this affects housing.
I like it.
Because it's Sunday and you'd probably rather watch something super cool like real estate analysis than boring old football games.
Absolutely.
Because all the good games were yesterday. All the college games.
There you go. And then, this comes from the man in the salmon-colored shirt, so he would know.
Salmon-colored shirt. All right.
Otherwise known as pink to the rest of us.
It's not salmon. It's salmon-colored. Okay, here's the article. Mortgage rates just dropped again, and more good news for housing this fall. Okay, Juana, I don't like first of all, I'm just going to say I don't like the title of the article. This is why. The assumption to me is that this people will read this and then they'll just skip on and they'll think, oh, well, the problem with housing is rates are too high, so nobody's buying. And all these homes are just piling up on the market. We need interest rates to go down to get rid of this massive supply of homes that nobody wants to buy.
Right. But if you have been watching our videos, then you know that what we have is insufficient supply of inventory, of homes, right? We have more buyers than we have homes for sale. And sellers are not putting their homes on the market for the same reason that buyers are having a hard time wanting to pull the trigger on the homes that are on the market, which is interest rates. People are still swooning over the 3% interest rates that they missed out on, or the 3% interest rates that they have and don't want to give up.
Okay, we've got 11 slides. I just went through and counted them. So be patient. Everyone has great information. It will make you smarter and more knowledgeable about what's going on in the real estate market. Okay, here's the first quote. Mortgage rates fell for the second week in a row, averaging 7.12% for a 30-year fixed rate loan in the week ending September 7th, according to Freddie Mac. Now, I know that we have some people who love to come in and find the highest rate or the highest estimate they can possibly find on the internet, put it in the comments saying, no, interest rates are actually 7.6 or whatever. This is Freddie Mac. Freddie Mac, literally, this is all they do. This is not somebody who just made this up. They have a survey. They survey the median rate of 30-year mortgages.
Right.
Okay. 30-year fixed rate loans.
Right. So Freddie Mac does know a lot about what's going on in the housing market. That is their whole mission, is the housing market. So they are very aware of that. Now, the reason that interest rates kind of took a breather is because the Fed will be meeting the September 19th and 20th, and they will be going over what to do about the economy and what to do about rates. The consensus is that, as Todd said, lots of the Fed governors have come out and made all sorts of statements in various forums about what they think should happen with interest rates at this meeting. And the general consensus is that nothing is going to happen, meaning interest rates will neither go up nor down at this meeting. There is still a strong sense that the Fed will still raise interest rates at some point before the end of the year, but the general consensus is that September 19th and 20th will simply stay the course and not see any drastic changes.
All right, here's the next quote. This downward trend, this is the last 2 weeks of mortgage rates, is a welcome relief after rates spiked to a 22-year high of 7.23%. 2 weeks earlier, still these rates are formidable, more than double what they were 2 years ago when they dipped below 3%, which has ground America's housing market to a near standstill. Actually, know somebody who got a 1.9% interest rate. Mm-hmm. So remember that 3% number is just median credit score, median 30-year fix on a median thing. If you get a 15-year, it's going to be less. If you do maybe a VA or something, it probably is less. Or some jumbo loan is less. Portfolio loan is less, right?
Right. Yeah. I mean, the lowest one that I saw, it was under 1%.
But that was a luxury. That was like a high-end home.
It was a jumbo loan, yes.
And I'm guessing it was a combination of they probably had $30 million being managed in their portfolio, and they just said, hey, look, I want to buy this house, but I don't want to pull funds out of all these things. Can I just get a super loan backed on my assets, right?
Right. I don't know the particulars. I was pulling a particular neighborhood to look at the loans in there, and that was the loan that caught my eye. So I don't know the particulars.
I remember you telling me it was under 1%.
Yeah. I think it was like 0.67 or something like that. It was just a ridiculous loan.
Could you if I could think about this out there, if you could borrow money at 0.67%, what would you do with it? Like, I think, I mean, you say, oh, I wouldn't do it in real estate. Sure you would. Why not? Because you can go buy real estate and then, because remember, you got to pay it back. So you go buy real estate, and even if the house does appreciate, you don't care, you're going to make way more than 0.67% in rent because you're going to rent the house out, and then you're going to be able to, your payment will be so low, the rent will be, a ton more than that. You'll be putting money in your pocket. And then the question is, like, you'd be able to, if you could buy 1,000 houses, you should buy them. Like, you could literally generate like a couple hundred, you could probably generate a few $1 million a month of cash flow if you could borrow an unlimited amount of money. And it would be risk-free, basically. You just go buy real estate.
There you go.
I think it's pretty risk-free. Okay, here's another quote. With the job market robust but cooling off and inflation slowing down, the market is not anticipating the Federal Reserve to increase rates in September, and is also less likely they will raise rates before year-end, predicts Spiano. She is an economist with NAR, or with Realtor.com. And also so we had two different governors came out. One was the Atlanta governor and one was, I think, Chicago, or a different thing. They both said they're very happy that things are going the way they're going. I think one of them used the word, the golden path, right?
Yes.
The golden path, which is what they're trying to say is we've nailed it. Like, we've exactly set interest rates at such where it'll slow the economy, it'll lead up all the inflation, but it won't crash the economy, yada, yada, yada.
Right. I mean, right now, I hate to agree with something so pretentious as to say that they've got the golden path, but right now it does look like they're doing a really good job and that they are being good stewards of our economy.
Okay. Now here's the quote, next one from the article. How high mortgage rates lead to fewer listings. Until mortgage rates drop, the supply of homes for sale will remain slim. Now, a year ago, the housing crashers in full force came out and said, housing is going to crash now, and this is why. This was the theory. Everyone would try to sell their house because they believed it was the top of the market. And then with interest rates, so all these homes would flood the market, and then there would be no one to buy them because no one would want to get a 7% loan. And then that would cause home prices to go down in order to move all the inventory. But there's a bunch of flaws with that one. And let's start with the first flaw.
The first flaw is that everybody needs somewhere to live. So if everybody sold, then where would everybody live?
Yeah, if you've bought a house and you've been in it for 3 or 4 years and you go, wow, I have $200,000 of equity in my house. This is great. And my mortgage payment's $1,100. Why would you sell the house and then go move into a rental and start throwing away the money? That makes no sense. So what happened is, first of all, is everyone didn't rush out there. There were some markets that were overbought. Vegas is one of them, where some homes did come on the market and people freaked out and panicked, dropped their prices, but it was a very short-term phenomena.
Right.
Because that was 10 months ago, and the median list price in Vegas is up $100,000. Mm-hmm. So we kind of had a dip. We called it moderate, which we said it was going to do, right?
Right. So, it still means that not everybody's going to sell. Everybody's circumstances are different. And what we've seen is just the opposite. Very few people are selling, right? That's why the number of transactions is down. The number of transactions is down because there are not enough homes to sell. Sellers have decided that they're going to sit where they are and they're going to wait it out for whatever has to happen for their particular situation to make them want to sell.
Here's the next quote. This has got some great numbers in it. For the week ending September 2nd, the number of new listings sank by 8.5% compared with 1 year ago. And what this means is that the number of new listings that came on the market a year ago, less came on this year. This is actually 58 weeks straight of less homes on the market than the same week a year prior. Mm-hmm. This is new listings are not happening. Mm-hmm. So less homes are coming on the market.
Right. Which is exactly what I said. Sellers aren't selling.
Right. Here's the next one. Well, the number of newly listed homes increased from July to August. Now that was just from July to August, which is normal. from July to August to September to October, the number of homes increased. But year over year, they were still down from like July of last year to July of this year, et cetera. Okay. New home listings have once again begun to decline as is expected heading into September. Actually, that's not true. New home listings don't decline. Usually more homes are still coming on the market going into September, right? September is usually, it's October, November when the buyers come back.
Right. So sellers tend to disappear over the holidays because they don't want their home on the market over the holidays because they've got family coming, whatever it is that's going on in their lives. Buyers want to be in that new home by the holidays, right? So they come back.
The other interesting thing is, now remember, these are national numbers. In Vegas, we're normally getting close to a peak of the most properties on the market, usually in September and October, and we're at the low. We have less properties on the market today than we had in May, which is unheard of.
Right. So this has not been a normal year as far as that goes, or as far as much else goes. So just because we don't have increased inventory doesn't mean that we won't. It just means that the patterns of the past are not a good predictor of what's going to happen for the rest of this year.
With 42% of all homes owned free and clear, and then everybody else except for 1% of the people who've just bought within the last year with a loan have higher rate. Everyone else has 3, 4, 5% rate. And those people aren't looking they're just like, I'm good. Right? Okay. We can say something?
Nope. Go ahead.
Okay, here's the next one. Fewer sellers are listing their homes. Since many have low mortgage rates, they're reluctant to give up, thus locking sellers into their homes and locking buyers out as a result. Overall inventory of both new and old listings has also declined, lagging behind year-ago levels by 5.2%. Now, what this doesn't talk about is cash.
Right.
They're really focused on low mortgage rates, but the only thing better than a 0.67% loan is 0% loan. You don't have a loan.
Yeah, and look, investors are out there, and they are out there in force. There are signs everywhere. We buy ugly houses. We buy houses cash. We buy fixer-uppers. I get repeated text messages from all kinds of investors on a daily basis asking me if there's anything off market that they can purchase. So there is definitely a robust investor interest out there in purchasing real estate, and that lets you know it gives you kind of a sense of what they see coming, right? So what they see coming is more demand for housing, even though there's already plenty of demand, and they understand that there's insufficient inventory, and if they can control that inventory, then they can sell it and make a profit.
Speaking of which, if you happen to know anybody selling a property in the $300,000 to $400,000 range in Vegas that would be a pretty good investment, we happen to know somebody that would be interested in maybe buying 2 of those right now.
There you go.
Okay? So if you're interested in selling your house off market directly to somebody, give us a call and we'll come chat with you.
Absolutely.
Cash purchase.
There you go.
No loan. Okay. Home prices edge upward. As if high mortgage rate were daunting enough for would-be buyers, low housing inventory has inflated home prices.
So that's it. No inventory, supply and demand. That's the name of the game, right?
Yep. For the week ending September 2nd, median home prices rose by 2.2% compared with last year. The good news is the home prices didn't top last June's record of $449. This is national. And that June, we still haven't passed in June. Now, that's only based on median. I think it was the CoreLogic home price index. We actually have exceeded it by indexed home prices, not median.
Right.
And the reason median is because if more homes sell in the lower end, which is what's happening, the median drops, even though the prices of the homes themselves are not necessarily dropping. So index, we did a whole video on that, talking about indexed home prices versus median home prices. But that's better than average home prices because that's even worse. Okay, here's the bad news. Home prices are not likely to fall dramatically anytime soon. A renewed existing home inventory crunch is still supporting listing prices as home buyers Find fewer opportunities compared to last year, adds Spianu. We were actually looking last year for some investment property, second home type stuff, and it was, depending on where you're looking, it was pretty meager. And what do you think, it's worse this year or about the same?
I think it's worse. There's really no inventory. And the thing about that is that it hurts everybody all the way around. Like I've said before, if you're a buyer and there's no inventory, you have nothing to buy. But if you're a seller and there's no inventory, that doesn't necessarily benefit you either, because most sellers end up being buyers on the other end, right? They're selling a home and then they're having to buy a home for to live in. So this lack of inventory is problematic for everyone.
Okay, here is the actual chart from the Freddie Mac website. If you go to FreddieMac.com, and I think it's FreddieMac.com, and you go look, it's the market survey. They do it every week. They track it. The two things you see, that blue line is the 30-year fixed rate mortgage, and it is the average that they, of all the banks that are loaning. And then you can see the 15-week, which notably exactly is less. And why is the 15 a lower interest rate?
So 15-year loans are a lower interest rate because there's less risk to the bank, right? Because their money is not tied up for as long of a term. Okay. The issue with that is, think about all the banks that loaned out those 1%, 2%, and 3% loans for 30 years. Those loans have a very low value as far as on the secondary market, because they're long-term loans at really low interest rates or very low rate of return, as opposed to if those loans were a 15-year loan, then they would have more value to an investor, because that money would be recaptured, recovered in a shorter amount of time, then you can loan it out at a higher interest rate.
So there's less downside risk for the investor.
Right.
Now here's another problem, okay? Let's say that you went and bought a house today at 7.12%, and the lender loans you the money, and then they package off that loan and send it off, and the Alabama State Teachers Retirement Fund owns your note. So every month when you send in your payment, they get that money and they disperse it to their people, right? Okay. Then interest rates tank and they say drop to 4%. You go, hey, I'm going to refi that loan. So you go refi the loan. Well, guess what happens? The Alabama State Teachers Retirement Fund, they get a phone call going, hey, we got great news for you. You know that loan you bought that was $400,000 at 7.12%? They're like, yeah. They're like, here's the $400,000. We're just going to give you the cash. But because they paid off, they refied the loan. So they paid off the loan. You don't own the loan anymore. It's gone. And you're like, oh, so I got the cash now. I don't want the cash. I want to go out and get a loan. I want to go buy another note so we can pay our people. And they go, well, you can, but all the loans we're selling now are 4% loans. So the way it works is, the problem with interest rate risk is, it's, in my opinion, it's always on the bank. The bank can charge you a premium, right, between what they borrow the money at from the Federal Reserve and then what they loan it out at. The problem is if interest rates go down, you can refi and get out of it. So the risk is not always on the home buyer.
Right.
If you can afford and you're qualified. Now, the other thing this chart shows pretty interesting is, remember we peaked above 7% last, like October, November a little bit, and then it dropped again, and then there was a point in January where we got below 6. Remember that? We were in the 5s for a 30-year, and then it's crawled back up into the 7s. So, Wanda, let's talk about the Fed. Let's say the Fed sits on interest rates for a year and then get numbers that say, hey, there's no inflation at all, but now the economy's starting to, maybe slow a bit. And it's not, because right now the economy, there was a projection of how fast the economy was going to grow. It's growing faster than that. So but the jobs numbers, we're still adding jobs. We're just not adding as many. Instead of adding 400,000 jobs a month, we're adding like 167,000 jobs a month. So what does that look like a year from now in mortgages if the Fed doesn't raise the economy, inflation goes away?
Well, with inflation under control or below their target rate, then the Fed's probably going to want to stimulate the economy a little bit, and they may entertain lowering interest rates. And I've said this before, I fully expect the Fed to lower interest rates probably They'll probably do it in the second quarter next year. I wish that they would wait a little bit longer, honestly, because I think it's going to be seen by a lot of people as a political move. And I really would prefer that politics stay out of our economy, which of course I live in a fantasy world as far as that goes. But yes, I do think that the Fed will try to spur the economy along to influence the election, even though no one's going to maybe say those words.
Okay. Do you think that's because, I mean, Fed governors tend to not all get replaced, right? Because
Right.
Powell was appointed by Trump.
Right.
It's not like Biden. It's not like,
They have 6-year terms.
yeah, they have 6-year terms.
They have 6-year terms. But, even having said that, I mean, that they have other constituencies as well. So we do have to remember that it's more than just looking out for their reappointment by the president. They have other constituencies. They have other things to keep in mind as far as what works to their personal benefit.
Okay, here's the bottom line. The average person who's still watching the video, thank you very much, at this point, most of this is super macroeconomic. A lot of them don't really understand it. And all they want to know is, when are the houses going to come back on the market in a large enough number where I have some choice? And then when are interest rates going to drop enough to where it makes sense to buy? And then the third thing is the question they always ask me: if homes come on the market but then interest rates fall, would home prices go up or down?
So homes will come back on the market. We'll probably have more inventory in the spring. Interest rates will probably drop sometime in the second or third quarter of next year. And if interest rates go down, home prices will go up, not down, because you'll have more people chasing homes. And even though we'll have more homes, you'll have more. The number of buyers will still outstrip the number of sellers out there.
Okay, so here's the basic of what Wanda just said. At interest rates of 3%, there was so much demand for housing. Home prices were going up 20% a year, right? Mm-hmm. Okay, so people thought, oh, well, at 7%, they'll have to drop because your payment went up, but that's not true. 7% isn't enough to choke off enough demand for housing to cause home prices to fall substantially, or even to fall, really to moderate, which means in some markets they go up, some markets they go down. And pretty much all the projections are that they'll go up over the next year. Nobody knows, right? Nobody really knows. I would say 5 or 10 years from now, there's zero question home prices will be worth substantially more than they are.
In most markets.
In most markets. There may be some markets where they're not, external events or whatever happens, right?
Sure.
So, Wanda, what's your final, what does this look like in the spring when maybe some more homes come on the market, but interest rates, say that 30-year fix is back at 6% next spring and there's more homes? Do you think we have a lot more people now off the sidelines trying to buy?
I think we'll have more transactions. I definitely think we'll have more transactions. And honestly, to some extent, I think that regardless of what interest rates do, we'll have more transactions in the spring, simply because people can only hold their breath for so long before they jump. People can only stay in a home that no longer meets their needs for so long before they just say, you know what, whatever, I'm just moving on because my life is worth more than having to wait this out.
Last question. If you found the house and said, I really like the house, and even though the interest rate's a little bit higher, and you could afford it, meaning you had 6 months of cash in the bank, you had enough money for the down payment, a lender would loan you the money with the normal, qualifications and everything, right? Would you buy the house, even though the payment's probably more than you really wanted to pay, and then wait a year or 2 or 3 and refi when the rates go down? Or would you wait for the rates to go down and then try to buy the house?
So my answer maybe is less economic and more life choice. And my life choice is that life is really short. So I would rather live in a home that I want, that makes me happy, that makes my life better. And I will deal with the higher interest rate short term and refinance later, than wait for an event that may or may not happen, such as lower interest rates or in some black swan event that would make the house more affordable as far as the price goes or anything else. Look, I have a limited amount of life and I would rather live it well. And I would, as far as a home is concerned, that's one of those things that I am willing to make sacrifices for to live well.
If you're waiting for the panacea of the perfect house at the perfect price, the perfect interest rate, and everything lining up, it's never going to happen. Okay. If you're a cash buyer, this is why cash buyers have always been cash buyers have way more leverage because first of all, they can pick when they buy it, right? They don't have to wait for interest rates, and they can be patient, wait out the market, and they don't have to play these games.
Absolutely.
And then they don't have a financial, is the house too much for me? Or is the payment going to be too much? They don't have a payment.
Right. So kind of in conclusion, I am not a fan of waiting for Godot. So if you know what that reference is, leave me a comment and tell me when you became aware of waiting for Godot, and if there's any language reference that you want to make, put that in the comments too.
Didn't you tell me the first time you saw that it was in Romanian?
It was in French.
Oh, it was in French.
It was in French, and it was, I was in middle school.
Was it in the U.S. or in Romania?
No, it was in the U.S.
Oh, you saw it in the U.S.?
Yeah, in middle school.
That was your second language?
Yes.
They do not know that English is not your first or your second language.
No, it's my third.
It's your third language, and yet you speak it perfectly.
It's my third that I've learned, but it's my primary language as far as what I speak.
Right, you speak it every day.
Yes.
Right. Cool. I only speak one language.
Should we ask what that is?
No, don't ask.
All right, so if you made it, kudos for you. You've got applause from me. It was kind of a slow video and we kind of meandered, so we apologize. Please remember to like the video, even though maybe it wasn't that great. Subscribe. We do get better, we promise.
Yes.
Hit the notification bell so you'll get notified about the Las Vegas market report for tomorrow, which we will have for you.
Yes, Vegas update tomorrow, Monday.
Yes.
I'll launch it kind of early.
Yes, all right. So thanks for watching. We appreciate you, and we'll see you on the next video. Bye.
Bye.